Hey guys, it's Chad Larson with August's Money Matters. Filming from a different location today. I do take holidays from now and again, so this is not my office, but it was important that we stay congruent with delivering this content to you on a monthly basis, more so at a consistency, but shockingly, seemingly, something happens once a month. It's news and noteworthy, to say the least. While on holidays, maybe a bit of a curse to it all, but seemingly we've had a market correction, something we've been addressing and talking about for months now. Every time I film and record one of these, I take the time to listen to and watch the previous months and the months before, just to see what the messaging is and if there's consistency, if there's some accuracy into some of the predictions that we make. As you're all aware, I'm an economist by training, and if it's the deadest science next to meteorology and on how often you can be right. We have been calling for a market correction at some point, and that doesn't make any of us a genius here by any stretch of the means. In any given year, going back to 1958, there's been 51 pullbacks of 10% or more. An intra-year pullback of 10% is very normal. We just had one. So while very weak, some softness in U.S. job data came out and spooked the markets. The Bank of Japan raised rates, which caused the Japanese market to tank, so to speak. It was down 11% in one single trading session. Lackluster earnings in some of the big tech names. Amazon got absolutely clobbered last week, down over 10% in one single trading session. So when you have these big sell-offs in the marketplace, again, we talk about time in the market far exceeding timing the market, but money deployed, a week ago doesn't look that fantastic. Money deployed since January. Listen, even with a sharp correction in the NASDAQ and the S&P, we're just back to early July levels. The markets have been very, very strong. So don't get overly fussed about that. Earnings reports, underwhelmed, and some fear about increased regulation in tech and lackluster AI performance. Like, the news cycle is going quite spinny right now, but max drawdown to relative, history. This is normal. We definitely have been calling for choppy markets into the election cycle that we see. It's about 100 days away into the U.S. We saw Joe Biden concede his run for presidency and Kamala Harris kind of take that running pole position. But into the election, we always see a little bit of heightened volatility, but thematically, things remain kind of consistent. The probability, like when I go back to January into these podcasts, the market came out like a rocket ship, expecting upwards of 6 interest rate cuts. Tech really lit the fuse to a market rally. The Magnificent Seven continued to drag the market further and further and further. And the steam of that trade is largely out. You've seen rotationally, I've been discussing, we have brought down our exposure to the S&P market weight into a more of an equal weight to try to capture more breadth of the market. When you look at the resilience in the marketplace, the Dow performed incredibly well last week, while tech-heavy indices like the NASDAQ got clobbered. So rotationally, I'm very pleased with where we see strategies right now. That doesn't mean there's not going to be bumps along the way. The U.S. economy, may have entered this recession as an unemployment rate rose over 4.3% in July. So some of the concerns that we're seeing, in the play out in the market is, while smart money has rotationally been rotating out of the big seven, seemingly last week people were just rotating out of the market. Even Warren Buffett slashed his stake in Apple, causing concerns over Apple. Listen, Warren was late to that trade, but now it's one of his biggest holdings. Like, he's taking profits. He's selling half his stake and is still one of the largest shareholders. And quarterly data came out incredibly well on robust iPhone sales. So you're always going to find a nugget, a headline. We seemingly get our information out of headlines and don't do any kind of deep delves into the academics of anything. But listen, Berkshire's raised cash. They got $277 billion. This all started with Wall Street wanted a September rate cut, and instead it got a bit of a baby step by Powell. All signs point to, and we have been talking about this higher for longer trade, and that the more coiled the market stays and the higher for longer typically ends up boding very well for the market. That being said, when you overdo things a little bit, things get a little bit choppy. So as you know, this baby step stocks are hurting, as a result. Wall Street was ready to scour remarks from Jerome Powell for hints that he might deliver a much anticipated rate cut in September, but the hint really never came. Now, trading probabilities are showing almost near 100% probability. We'll get a bit of a deeper cut come September, probably 50 basis points, followed by October 50 basis points, and the market is kind of guiding and trading towards a couple 25 basis points cuts, thereafter. So the stock market is feeling the consequences, of that. And here we go. So this, route within the marketplace, like, this is not really economics driven. This is always fear of a soft landing, fear of, do we trigger a recession into the US? Consumer discretionary, as I discussed last month, has been a sector we've rotated, away from. Some fears over a consumer-led recession into the US is obviously gripping the oil markets quite a bit, forecasting kind of some weaker demand. Again, short-term news nuggets also where traders can trade and they spook retail markets in and around, whipsawing portfolios, but the fundamental supply and demand over the long term, over finite resources with extraction technologies seemingly developing but taking longer time to come to the market, will create this tight oil supply that we remain fundamentally aligned to, more of a tilt into international markets. But after the second year of a bull market is typically it's a tougher year. The easy stuff, it's not gone, but we have to be cautious that these declines that happen are tactical opportunities. We use the liquidity across portfolios, and just remember, we're not 100% invested in equities. We're not 100% invested in the NASDAQ. We're not 100% invested in Amazon stock. The inclusion of alternatives, the inclusion of fixed income, the inclusion of other asset classes across portfolios seek to dampen and also enhance outcomes by managing volatility across portfolios. We've seen the VIX spike to levels we haven't seen. That's because it's just been going so good for such a long period of time. If you live in a nice neighborhood and you've never heard a car backfire, it kind of spooks you a little bit. But if you're used to backfiring cars and shots ringing out in the evening, these things don't tend to surprise you. So things have been good for a while. Things are going to continue to be economically sound. We're going into a bit of a choppy period, as expected. These are not straight lines. But listen, the S&P closed at its lowest level since June 4th. June 4th was not that long ago. We're not seeing multi-year destruction of wealth across marketplaces. So, my phone's definitely not, ringing off the hook, so to speak, by any stretch of the means. But, people will catch into the news. It's a holiday today in Canada. U.S. Session is open, but, recession fears have rattled the stock market. And, will this great rotation trade, roll on? Rotating into safer sectors offers limited benefits. I mean, it's rising volatility across the entire stock market for the rest of the summer. But, this, again, kind of in wrapping, I'm not going to be long and drawn out on this. Again, anchoring, kind of our job is not to impress you, but to impress upon people the fundamental reasons of broad market diversification. Last month, we did initiate a long position in ex-US, ex-Canadian international stocks. We have been concerned. We have been enjoying the ride that we've seen in the US economy, and continue to have a proxy and a viewpoint that into 2025, a synchronized global economic recovery, along with a historic amount of cash on the sidelines, driven by strong but subtle tailwinds across AI, making profitability gains for all companies, will lead to increased economic activity, increased earnings per share growth across broad sectors, and very constructive into the marketplaces. But the stock market's going to tumble 1 week over, and it's going to test people's, resilience and portfolio construction, and really more, can you stay the path? Managing liquidity, managing cash flows, managing, Investor expectations, I think, is first and foremost something that we take caution of. This is not just an academic game. We're dealing with real people, with real money, with real emotions, and managing, how people feel about their investments is equally important. It's something I've said time and time again, and whether there's anything to it, I've built a career off of it, is how you feel about your investments is equally as important as what you're invested in. Being comfortable with the people, the process, and the philosophy of how your capital is invested generally creates resilience in and around stomaching and going through periods of volatility. I try to make airline examples all the time. There's turbulence. It happens. And it's the captain's job to walk the aisles, to make the announcement, to say, hey, we expect some turbulence ahead. Sit down, keep your seatbelts on, but we're built for this. And this was just some mild turbulence along the way. This is normal course of business, and we remain constructive. We remain nimble and tactical. We have ample liquidity and viewpoints to where we can take advantage of opportunity sets. And so this rotation out of overvalued tech stocks and into the broader market, has worked. And so we've seen, less drawdown than broader indices. But, when the market wants to rotate out of everything and kind of make a run on it, you're going to feel some bumps along the way. So into the election, we're going to see a little bit more volatility. But we're excited about what we see in front of us. Again, any one member of my team is available to discuss broader concepts, positioning strategies of what we see, what we're excited about, what we're concerned about. Day to day, we're making these decisions. Day to day, we're meeting with our advisors, our key partners, our key capital advisors, ensuring that our second engine, our checks and balances, and our processes remain sound to navigate capital markets. Everyone is very tolerant of upwards volatility. No one's very tolerant of downwards volatility, but it's a normal part of life. So with that being said, I am going to sign off and keep this one quite short. Again, thank you so much for the trust and confidence in being our private client. You guys have a wonderful August, and I look forward to seeing and speaking with many of you over the next coming weeks and into the fall. Have a wonderful day, and take care.